welcome back, everybody. We're going to reconvene for this afternoon session. We're going to start off talking about group life insurance. Group life insurance. Group insurance concepts. It's a two-party contract between who? Between your employer and the insurance company. You as an employee of this group do not own anything. The employer owns the contract. The employer pays the premium to the insurance company. Now, they might choose to pay all of the premium themselves. That means it's a non-contributory plan. It means you, the employee, do not contribute toward the premium payment in any way. The employer is paying it all for you. Therefore, it is known as a non-contributory plan. If you, the employee, are paying any portion of the premium, then that portion of your premium you're paying is taken out of your payroll check by the employer. The employer still cuts one check, pays it to the insurance company for the premium on the group life plan. So it's a two-party contract between the employer and the insurance company. Only one master policy, only one master contract is ever created, and that is hand-delivered by the agent to the employer. The employer owns the policy, so they receive the master contract. You, as an employee of that employer, receive what we call a certificate of coverage booklet, because you are known as a certificate holder. Premium payment, if the employer, as I said, pays it all for you, then it's known as a non-contributory plan. Always think of contributory versus non-contributory questions from the standpoint of the employee. If you were in my classroom, I would make you all employees of the same employer to have this discussion with you. So, you guys on Zoom today are all employees of the same employer. You all work for the same employer. Your employer has decided to offer group life plans, to a group life plan as an employee benefit being offered to you through their group benefits. So, if that employer pays all of the premium for you, it's known as a non-contributory plan, because you, the employee, do not pay any portion of the premium. Your employer is paying it all for you. So in a non-contributory plan, the employer pays all of the premium, and they must cover 100% of employees. They must have 100% participation when it is a non-contributory plan. A contributory plan means you, the employee, are paying a portion of the premium. The employee pays all or part of the premium, and the employer pays the rest. In that case, they must have 75% participation of all employees. The employer is the owner of the contract and retains all ownership rights except the right to name and change a beneficiary. That right is still given to you, the certificate holder. You would fill out a card to join the group life plan, and on that card is your name, your beneficiary. Group insurance has more liberal underwriting than individual insurance. Group as a whole is evaluated, not individual members of the group. So group underwriting on group life insurance is different than individually owned, individually issued life insurance policies. The group as a whole is evaluated, not individual members of the group. So generally no individual underwriting is done. Good risks outweigh bad risks. That's okay, but adverse selection is when more bad risks outweigh good risks, and no insurance company wants that. They want their underwriter highly skilled, highly trained in analysis of risk. And they definitely want to insure more good risks than bad ones. They know in a group situation, some people won't be as healthy as other people. Some people will be in exceptionally good health. Some people will be almost borderline poor health. But the majority will fall in the middle, somewhere between very good and very bad. Okay? And so, underwriting on a group life plan is done on the group itself, not on individual members of the group. So we definitely want to insure more good risks than bad ones, for sure. Impairments are covered, and enrollment periods are held to. Usually an open enrollment period to join a group life plan is 31 days after you've celebrated and completed your probationary period that employer has put you on as a new employee. Once you satisfy the probationary period set by the employer, then the group life plan is generally opened up for 31 days. You have an open enrollment period to join the group life plan. Now, law of large numbers is simply a mathematical concept that says the larger the number of members of a group, the more predictable the outcome will be. And the smaller the members of the group, the smaller the group is, the less predictable the outcome will be. Therefore, the higher risk, therefore, the higher premium to be charged. So, law of large numbers. It's a mathematical concept. It's easier to predict losses with greater accuracy with a larger group than it is a smaller group. Individuals cannot form a group with the sole purpose of obtaining group insurance. You must be a group formed for some other purpose other than just to buy insurance. Otherwise, you're not considered a group. Got to be a group formed for some other purpose other than to buy life insurance. But when we talk about group health insurance later, you got to be a group formed for some other purpose other than to buy group health insurance. Okay? So individuals cannot form themselves and call themselves a group for the sole purpose of obtaining insurance. Group insurance. They must have a common bond, such as a trade association, a union, just to name a few examples. Employer-employee relationships, that's a group formed for some other purpose other than just to buy insurance, for sure. Conversion option. When an employee leaves the group, they have 31 days to convert to their own standalone, individually owned life insurance policy. And most insurance companies will require you, if you're covered by a group term policy, to convert to a standalone, individually owned, permanent cash value life insurance policy. They don't allow you to convert from term to term. They only will allow you to convert from term to some sort of permanent cash value life insurance policy, such as whole life, UL, or VL contract. But your conversion option is within 31 days that you have to convert to your own standalone, individually owned life insurance policy, individually underwritten then at that point. And you can do that within a 31-day conversion period without proving evidence of insurability. Okay, so you only have this 31-day window to convert without proving evidence of insurability. Death benefits are provided during the 31-day period and paid for by the group plan. You can convert from term to whole life at your attained age you have become. And most insurance companies will not allow you to convert from term to term, only from term to some sort of permanent cash value life insurance product. No medical exam or health questions as long as you convert within that 31-day conversion period of time. That is the end of section 4. We move on with section 5, annuities. Annuities. Now, what is an annuity? An annuity is an account you establish at an insurance company. They are long-range planning vehicles. Biggest use of them is to plan for retirement planning purposes, to provide an income for this individual at retirement or well into retirement years. We use annuities for a large amount of different things. Lawsuit settlements. You receive a lawsuit settlement and it's a large amount of money, and they agree to pay it out to you over a period of time. They could put that money in an annuity with an insurance company and guarantee payout over a certain number of years to you. You win the lottery, state lottery. We'll put the money in an annuity and pay it out to you over time unless you decide to receive your lottery winnings in a lump sum. So if you paid lottery winnings any other way other than a lump sum, because you don't want as much tax being withheld and sent to the federal government, you could choose a different way to have it paid out to you, keeping more of the money yourself. But it's generally paid out over a period of time. And in order for that state to guarantee that payout, they put it in an annuity with an insurance company that can then guarantee that payout stream for those years that it's going to be paid out to you. So what is an annuity? An annuity is an account, an investment vehicle established by an insurance company which allows for the tax-deferred growth of the contributions placed in that annuity during the accumulation period. There's 2 periods of time of any annuity. There's the accumulation period when you're putting money in and allowing it to stay there and allowing it to continue to grow. So you might establish it with one lump sum and just keep adding to it, adding to it, adding to it. As you have more additional money, you're putting more money in, you're allowing it to stay there, allowing it to continue to grow from your tax deferred. You're pushing paying taxation out on the buildup of the money until you reach retirement or well into retirement years. Then when you annuitize and start to take the money out, then you'll pay tax on growth. If after-tax dollars went in and they grow tax deferred, then when you take the money out at retirement, you pay tax on growth only. If it is an annuity established with pre-tax dollars that come, let's say, from a qualified plan, like your 401k plan with your employer, or like a SEP plan with a small employer, or a KEO with a self-employed person. If the money comes from a qualified plan and gets rolled over into a traditional IRA annuity, and then you start to annuitize that annuity, you will pay tax on anything you take out. Because when pre-tax dollars go in that have never been taxed and grow tax deferred while they're in there, then when you take the money out, you'll pay tax on anything you take out. If after-tax dollars go in, you establish an annuity by writing out a check out of your checkbook, then those are dollars that have already been taxed. So when they go in an annuity and grow tax deferred, when you annuitize and take the money out at retirement, or you take the money out in frozen drafts, when you take the money out that's considered growth, you'll pay tax on it. Any amount that comes out that's cents return of principal, you will not pay that money. The principal. If pre-tax dollars go in, road tax is good. No taxes get paid on any of those dollars yet. So when the dollars come out, the person is going to have to pay back on anything they take out. If the federal government wants its fair share of money, and it's going to get its fair share of tax, for sure. If after-tax dollars go in, dollars out of a person's checkbook, go into a non-qualified annuity, then they stay in there and they grow tax deferred for the individual until retirement. Then when they retire and start to draw the money out, they pay tax on growth only. GROWTH. They pay tax on growth only because the principal dollars they've already paid tax on. So a person invests funds on either a lump sum, you can establish an annuity with a lump sum of money, or you can establish it with a very small amount of money. Most insurance companies will allow you to start with as little as $25 or $50 to start with, and you just keep adding money to it, adding money to it, adding money to it. As you have extra money, you place that money in the annuity as well. That's called a flexible premium deferred annuity. So a person can invest funds in either a lump sum by dropping in a certain amount of money. Maybe you sold off your boat, or you sold off your vacation home, or you sold off a piece of land that you intended to build a house on, but now you don't want to build there. So you sell the piece of land. You sell this asset and you have a lump sum of money to do something with. What better place to place it than an annuity and let it grow tax deferred for you for retirement purposes later on in life? You have income coming in, you're still working. Why not place this money in a tax deferred environment and let it grow for you on a tax deferred basis, where it will compound faster there and work and earn better performance for you there than anywhere else, because you don't have to pay tax as it builds up. It's a tax deferred instrument. You're pushing pay out into the distant future, as far into the distant future as you can, which is retirement or well into retirement years before you start to take the money out. Then when you take the money out, you got to determine how the dollars went in. If they went in pre-tax, then any money you take out will be taxed. If it went in after tax, when you take the money out, you pay tax on growth only. Okay? So a person invests funds on either a lump sum or a periodic basis, and can be either an immediate annuity. An immediate annuity has to be established with a lump sum of money. A lump sum of money has to go in, because you're immediately telling the insurance company, I wish to have this paid out to me, and I want it paid out to me monthly, and I want to choose one of the 6 ways to have it annuitized and paid out to me, and I choose one of those 6 ways, and that actuary calculates out what that dollar amount is, and I'll be receiving my first check in the first 30 days. And once it starts, it will not stop. It will continue to pay me out one of those 6 ways I chose to have it annuitized and paid out to me. So, immediate annuity means I need immediate income from it. So I've got to establish that with one lump sum of money. But the payout is based on the dollars in there. So I can't be adding to it at the same time I'm drawing money from it. There's 2 phases of any annuity. One is the pay-in phase. That's the accumulation phase. That's the pay-in period of time. And I can just keep adding to it, adding to it, adding to it, and stay in that accumulation phase as long as I want to. But when I start the annuitization phase, that's the payout phase. And once I start annuitization, it cannot be stopped. And I will cease being in the accumulation phase then, and I will now be in the annuitization phase, which is the payout phase. I cannot switch from the accumulation phase to the annuity phase and back to the annuity phase. I stay in the annuity phase of an annuity as long as I want to be there. But the day I annuitize and start the annuitization payout from my annuity is the day I cease being in the accumulation phase, and now I will be in the annuitization phase, the payout phase, the rest of the life of the contract. I cannot switch from one to the other and back to the other again. I stay in the accumulation phase as long as I need to be there. Once I start the payout phase, the annuitization phase, I remain in the annuitization phase the rest of the life of this contract. So the contract has a death benefit if the owner dies during the contribution period, during the accumulation period. The death benefit is the amount of money I placed in it plus the amount of money it's become. That is the death benefit on an annuity. See, life insurance was this. You paid this premium in, and this was the death benefit paid out to your beneficiary if you died. And the difference between those 2 numbers is the net amount of risk that the insurance company assumes on their shoulders. You pay this premium, you have this death benefit paid out if you die. That's insurance. An annuity is not an life insurance policy. An annuity is a vehicle you establish at an insurance company whereby you contribute money, place dollars in it, and it grows and earns interest, or it grows and earns investment performance if it's a variable annuity. And if you die before the annuitization process begins, that is the death benefit. That is an annuity. placed in it, plus money it has grown to become, that is an annuity. So it's not a life insurance contract. Life insurance helps us create the estate for an individual. An annuity will help us to liquidate that estate by providing retirement income at retirement or throughout the person's retirement years. So the contract has a death benefit if the owner dies during the contribution period, and that's equal to the amount placed in the annuity plus any growth it has assumed. Many contracts guarantee that the owner will not run out of money in retirement even if the funds are exhausted when a lifetime payout is chosen. There's 6 different ways a person can choose to have an annuity annuitized and paid out to them. One of those 6 ways is a lifetime payout. And if you choose a lifetime payout, you are guaranteed a payout the rest of your life. If you keep on living, you keep on receiving. Even after all the money has been paid out to you plus interest, if you keep on living, you keep on receiving. You keep on receiving then the insurance company's dollars. So many contracts guarantee that people will not run out of money. It's the only vehicle that can guarantee you an income stream for life. No stock can do that. No bond can do that. No piece of property can do that. No piece of real estate property can do that. No rental piece of property can do that. Nothing can guarantee you an income stream for the rest of your life. The only vehicle that can do that is an annuity. So it satisfies a very particular niche in a person's financial portfolio. Immediate annuities are purchased with one lump sum payment because I can't be adding to it at the same time I'm drawing money from it. And with an immediate annuity, I receive the payout immediately. So I got to put a lump sum of money in there, and I instruct the insurance company to calculate out one of those 6 ways I choose to have it paid out to me, what the amount is going to be. And once it starts, I'll have my first check in the first 30 days, and it will continue to pay me out. That way I have chosen to have it paid out to me. It will not stop until either all the money is paid out to me or I die. One or the other. Immediate annuities. Purchase in one lump sum with the payout generally starting immediately. That's why it's called an immediate annuity. And it's got to be funded with one lump sum of money. Deferred annuities are purchased with periodic payments, and payout typically starts after retirement. You're deferring paying taxes, you're putting the money in, leaving it grow, letting it stay in there, letting it grow, tax deferred for a retirement payout later on, usually at retirement or well into your retirement years. Annuities are contracts that provide income for a fixed period of time or for an annuitant's lifetime. Systematic liquidation of an estate or pool of money is known as the definition of an annuity. It is the opposite of life insurance. See, life insurance, once you own your life insurance policy, it's an asset you own. And the value of that life insurance policy is the face amount of it. So when you own that policy, your overall estate value just increased by the amount of the face amount. If you own $1 million policy on your life, and you get it issued on your life, and you own it, now your overall estate value just increased $1 million. Because the value of any life insurance policy is the face amount of it. An annuity, so a life insurance policy helps you to create an estate for yourself, but an annuity will help to liquidate that estate. Many times as you sell off different assets, you place it in an annuity. And then when you get ready to annuitize an annuity, maybe choose a life insurance. Now you know you can never outlive your money from that annuity. That annuity will be paid you all the rest of the days of your life when you choose a lifetime payout. So systematic liquidation of an estate or pool of money, and that is definitely the opposite of what a life insurance policy does for you. It is a product sold by life insurance companies. The only place you can buy an annuity is through a life insurance company. Protection against the outliving one's income. And it is a savings program growing on a tax-deferred basis to provide you income for a point in your future. Generally, retirement once you're well into retirement. Annuities should always be sold as long-range planning vehicles because they got back-end surrender charges on the back end. And if a person puts the money in this year and takes it out next year, they're going to get hit with back-end surrender charges. They are meant to be long-range planning vehicles. That's why those back-end surrender charges exist on the back end. So a person doesn't put the money in this year and take it out next year. They're long-range planning vehicles, and they should always be sold as long-range planning vehicles by an agent who sells them. If you don't, you're going to get yourself into trouble. Because people are going to hold you accountable for what you tell them. And when you don't tell them it's a long-range planning vehicle, when you tell them, oh, it's liquid, you can get your money anytime you want, and you don't tell them about the decrease in surrender charges, which you have to document in writing and disclose in statements, they're going to be complaining against you to the State Department of Insurance. And then you got all kinds of problems coming your way. You don't want that to happen, so According to the source of income, fixed annuity provides safety and security principle. When you establish a fixed annuity with an insurance company, your premium dollars go in the general account of the insurance company. They become an asset of the insurance company. The money managers now take those dollars in the general account and invest them in different vehicles around the world and give you a set interest rate on your annuity for at least 12 months at a time. And if you want to lock in an interest rate with that insurance company for a longer period of time, they will give you the option to lock it in for maybe 3 years, maybe 5 years, maybe 7 years, maybe even as long as a 10-year lock-in period of time. Because interest rates are edging upward, most people are investing their money and only locking it in for a 12-month period of time because they hope that by next year, if interest rates go up, then their interest rate would go up. Your interest rate renews. If it's a 1-year interest rate on an annuity, it renews every year. So in the 11th month, the insurance company will send you documentation stating what your interest rate will be for the next year. And so it could renew higher. If interest rates go higher, it could renew the same as what you've been receiving the past year. It also could renew lower if interest rates go lower again. So fixed annuities are can provide a predetermined monthly income for life if you choose a lifetime payout. Your dollars go in the general account of the insurance company and become a general asset of that insurance company, backed up by the assets of the insurance company. The interest rate is guaranteed, and you lock it in for 1, 3, 5, 7, or 10 years. Generally, a 1-year interest rate. Limits policy owner risk, because I have transferred the money from my checkbook over to the shoulders of the insurance company, and now it's in the big general account, becomes an asset of theirs, and now they invest it, and they pay me interest on it. So it limits the policy owner's risk. The insurance company assumes all the risk in a fixed annuity. But in a variable, I maintain all the risk right here on my shoulders. In a variable annuity, I establish the variable annuity with an insurance company selling variable annuities, and my premium dollars go in the separate account of the insurance company, money that has to be kept separate from general account money. So I pay the dollars to the insurance company, it goes in the separate account, then I instruct them how I want my premium dollars invested in the different sub-accounts known as aggressive stock account, common stock account, bond fund, balance fund, fixed account, money market account, or managed money accounts. And I instruct them, percentage-wise, how much of my premium I want invested in each of those sub-accounts. Then I am responsible for the performance. I can't tell what the stock market's going to do, but I can't hold the insurance company accountable for bad performance when I've instructed them how I want my dollars invested. So variable annuity, monthly benefit varies per performance. Your money goes in a separate account. The separate accounts consist of different stock and bond accounts and sometimes a combination of both. If it's a balance fund, it gives you higher potential return. Not higher guaranteed return, because there is no guarantee on a variable product, ever. Only higher potential return, because there's no guarantee of anything in a variable product. The policy owner assumes all the risk, and it is required that you have a Series 6 or Series 7 license issued to you by FINRA, Financial Industry Regulatory Authority. That's when you become a registered representative, because you now have a Series 6 or Series 7 federal license issued to you. Gotta have a Series 6 or Series 7 to sell anything with the word variable in it. So here we're talking about variable annuity. You also have to have Series 6 or Series 7 before you can sell variable annuity. How the premium is paid on an annuity in a lump sum or single premium, the contract is fully funded then with just one payment. Periodic premium means I start it with a small amount and I just keep adding to it over the course of my working lifetime. I could put a level premium in there, like $100 a month, $100 a month, $100 a month. I could put $25 in this month, $50 next month, $100 next month, drop in an extra $500, drop in an extra $1,000, drop in an extra $10,000 when I have the extra money that I want to put in. The periodic premiums can be a level premium that I set up to pay in, or it could be flexible premium, either one. When the benefit begins now, on an immediate annuity, my payout will begin immediately. That's why it's called an immediate annuity. So I got to fund that thing with a lump sum of money. My first payment begins within 30 days from the deposit of the money. And can only be funded with a lump sum payment. A deferred annuity, however, I can start with a small amount of money and just keep adding to it over time. A deferred annuity means I'm going to put money in over time, leave it there, let it stay there, let it continue to grow on a tax-deferred basis. I won't have to report any of the growth as taxable income until I get to retirement, well into retirement, and take the money out. that's when I will have to pay tax, at least on growth or on the whole amount, if pre-tax dollars went in it from a qualified plan. So deferred annuity means I'm deferring the payment to a later date, such as retirement or well into retirement years. Now, payout. Payout of an annuity. There's 6 different ways. You can choose to annuitize and have an annuity paid out to you. Keep in mind, too, you don't have to annuitize an annuity to get your hands on the money. People that don't understand annuities think so, but that's not true. If I had this annuity I've been contributing to for 30 years, and I get to retirement, and I call up that insurance company, and I want to take $5,000 out to buy a new car to take me through retirement years, I could do that. I don't have to annuitize my annuity to get my hands on the money. I just could call the insurance company and say, hey, I want to take $5,000 out, put it as a down payment on one of the last cars I probably intend to buy that will probably take me through my retirement years. They'd cut the check for $5,000 and send it to me. I'd have to pay tax on the whole $5,000. If pre-tax dollars went in, I'd have to pay tax on growth if after-tax dollars went in. Because I don't pay tax on my principal dollars if after-tax dollars go in. But if pre-tax dollars went in, then if I pull $5,000 out, then I got to pay tax on the growth and the tax on the principal, because the principal went in pre-tax, not after-tax. Okay? So, I could take it out in dribs and drabs if I want. I could contact the insurance company, take the $5,000 out for the new car. Maybe the next year I don't want to take anything out. Maybe the next year I want to take $3,000 out. Maybe the next year I want to take $10,000 out. Maybe the next 5 years I don't want to take anything out at all. So I can take money out in dribs and drabs if that's what I want to do. But I do have 6 ways to annuitize my annuity and have, once I start it, a nice, steady income stream coming into my household to help me subsidize my retirement years. And the only way I can get that is to annuitize my annuity. But I don't have to annuitize an annuity to get my hands on the money. I could take it out in small amounts, only the amount of money I feel I need, and leave the rest in there, continue to grow on a tax-deferred basis. Now, when I do decide that annuitization is going to be the best route for me to go, because maybe I'm at retirement, maybe I've been in retirement for a number of years now, and now I want a nice, steady income stream coming into my household to help me subsidize the rest of my retirement years with a set amount of dollars, then that's when I might choose to annuitize my annuity. And I have 6 different ways to choose to have it paid out to me. The first way is to choose a straight life payout. That means the insurance company is going to guarantee me paying a check to me the rest of my life. If I live to be 115, that check is still going to be, coming to me. The day I die, though, is the day all payout stops. And if I haven't lived long enough to have all the money paid out to me plus interest in the account, then the insurance company will keep the remaining balance. But if I live long enough to have all the money paid out to me plus interest, and I keep on living, then I keep on receiving. And at that point, I am receiving and living off from the insurance company's money, not my own. Because my own money got paid out to me plus interest a long time ago. So choosing a straight life payout assures me of a payout stream the rest of my life, no matter how long I live. No matter how long I live. As long as I keep living and breathing oxygen, that payout will continue. The day I die is the day it stops. So some people with longevity...
You can go, Dave. I just don't have any cash to use.
I told you, I got
Okay.
a man who's going
Like, I have to put it in for the electric bill.
Grandmother lived to be 88, mother lived to be 95, other aunts are 96 and 97, her sisters are all 96 and 97 now, right now. So I have longevity definitely in my life. For females, at least. For females, at least. So, people who have longevity in their family might consider a straight life payout. Because they say to themselves, if I retire at 65,
If you can get something for whatever's in the box.
which a lot of people are doing nowadays.
I don't know how much is in there.
They're living longer than 35 years in retirement. So this option is becoming more and more popular for people to choose. Why? Because they know they have longevity on their side. Now, even if they don't have longevity on their side, maybe they don't have anybody else to depend upon. Maybe their husband or spouse is dead, all the brothers and sisters are dead, parents are long gone, didn't have children, therefore they have no grandchildren. They have to be dependent upon just themselves for the rest of the years of their life on the planet. So they want to annuitize their annuity and have a straight life payout paid out to them the rest of their days. And once they're deceased, they're not going to worry about payout to anybody else. They don't have anybody else to leave the money to anyway. Why not make sure that their needs, their income needs, are taken care of? So straight life payout is a very definite option chosen by a lot of people nowadays. Straight life payout or pure life payout, here the income is received by the annuitant for life, for their life, with no refund to any other survivor. A beneficiary is not named on a straight life payout, but it's only being guaranteed to be paid out to one person by the insurance company. And when that one person dies, all payout stops. There is no survivorship. It's the greatest risk to the annuitant's beneficiary, because it's not going to be paid out to anybody else except the annuitant. They will provide the largest monthly income though. You want the largest monthly check? This is the way you get it. You choose a straight life payout. It will provide you the largest monthly check. It will provide you that largest monthly check for the rest of your life. As long as you keep on living, you will keep on receiving that check amount. But the day you die is the day all payout stops. Now, if you keep on living to be 105, long after all the money you paid in the annuity plus interest has been paid out to you many years ago, you have been living on the insurance company's money all these years. It's just if you die prematurely, before all the money gets paid out to you, then there is no beneficiary named. And any money not paid out to you will be kept by the insurance company. Why do they keep it? To have money to pay the person that does live to be 105 or 110 long after the money they put in the annuity is paid out to them and they've chosen a straight life payout. Okay? So yes, straight life payout, pure life payout provides you the largest monthly income check you can get, and it pays it to you over your lifetime. The day you die is the day payout stops. And it also is the greatest potential overall benefit over the lifetime of the individual. Now, you don't have to choose straight life payout if you don't want to. That's just one of the 6 ways to choose to annuitize and have this annuity paid out to you. You could have it paid out over your lifetime, and if any remaining balance remains once you die, you could have it paid out in a cash refund type situation, where any remaining balance is then paid out to your beneficiary. Now, what does that do to your monthly check? It lowers it. So you get a lower monthly check, guaranteed that if you don't live long enough to receive all the money, then your beneficiary would get it in a lump sum. You also have an installment refund option, that if you don't live long enough to receive all the money, and you die, then the beneficiary you have named will receive the same monthly installment, same monthly amount that you have been receiving until all the proceeds are paid out to them. You also have a life with period certain that has 2 components. Insurance company is guaranteeing paying it out over your lifetime, and also for a certain period of time to either you or to your beneficiary, until that period certain is satisfied. So life with period certain is 2 components. Insurance company is guaranteeing paying it out over the life of the annuitant, but for a certain period of time. If the annuitant lives, then they will get the money. If the annuitant dies before the period certain, then we have satisfied the life component. We paid it out over the life of the annuitant. Now we must satisfy the period certain component and pay out the remaining monies to the beneficiary until the period certain has been satisfied. So that's known as a life with period certain survivorship disposition. So life with period certain, 2 components. The income is guaranteed by the insurance company for the life of the annuitant, with survivor benefit if the annuitant dies before the end of the term or designated period. Now, if they choose a life with 5 years certain, it would be a 5-year certain. Life with 10 or 15 or 20 years certain, life with 10 or 15 or 20. So life with 10 years certain means the proceeds are going to be paid out over the life of the annuitant. If they died, let's say in year 5, all right, we've satisfied the life component. Now we got to pay the remaining proceeds to the beneficiary for the next remaining 5 years, because that person chose a life with 10 years certain. They didn't live the whole 10 years. If they had lived the whole 10 years, they get the money. But they didn't live the whole 10 years. They died in year 5. So now we satisfied the life payout over their lifetime. Now we got to satisfy the 10-year certain component and pay the remaining balance in the account plus interest to the beneficiary for the remaining 5 years, to satisfy the 10-year certain component of a life with 10-year certain payout. Unit refund life annuity, annuitant receives an amount at least equal to his or her original investment. At death, any remaining amount is then paid to the beneficiary. Now, you could choose to have it pay out over 2 people's lifetimes, not just one. The first one we talked about was straight life. That's over the straight life of one individual. But a married couple might choose to have a payout of their annuity paid out over both of their lifetimes. Joint life means it would pay out, it would be factored based on their life expectancies, based on their ages, based on their genders now. And a joint life, the insurance company is guaranteeing payment to 2 or more annuitants, which ceases on the death of either one of them. So joint life stops paying when the first one dies. Joint and survivor, however, starts paying out when the first one dies. The payout continues until the second one dies. So that's known as joint and last survivor payout. Payment to 2 or more annuitants, the payment does continue to the survivor until that survivor dies. When the survivor dies, all payout stops. Now there's 2 versions of that. Joint and last survivor, which is joint in 1/2 or joint in 2/3. Meaning they get the larger check while they're both alive. When one dies, the survivor gets 50% of whatever that check amount was. Or joint in 2/3, they get the larger check when they're both alive. When the first one dies, the survivor gets 2/3 of that amount. And many times married couples will choose a joint 2/3 or joint 1/2 payout because they know they get greater money.
Was it good?
When they have larger life, when they have larger.
Yeah, baby. Anything for you.
Then when one dies. When the one dies, they'll sell off the second car. They want a car insurance on the second car. They want a
Crystal Light.
second car. They won't travel as much because they don't have each other. They might downsize from the bigger house to a smaller condo, or maybe even assisted living at that point. So their expenditures are going to be a lot less when one of them dies. They want the largest check when they're both alive, and they want the survivor to know and realize that when the first one dies, their check will be diminished down to 2/3 of that amount. And they're okay with that because they know there'll be certain expenses that won't be incurred anymore with the first one deceased. Okay? Equity indexed annuities, we have dropped over the years the name equity off indexed annuities. Now we just call them indexed annuities, IAs for short. Indexed annuities are a form of fixed annuity that you can sell with just this license, this state license. It allows for stock market appreciation with downside protection. It's a type of fixed annuity where the principal is guaranteed by the insurance company. Money for an index annuity also goes in the general account of the insurance company, and that becomes an asset of the insurance company, backed up by the assets of that insurance company. So it's a type of fixed annuity. An index annuity is a type of fixed annuity. That's why we dropped the name equity off its name. Because people were confused. They didn't think they could sell them with just this state license. But because they're a type of fixed annuity, you can sell them with just this state license. So that's why we no longer call them equity indexed annuities anymore. We call them IAs for short, indexed annuity. So they are a type of fixed annuity which guarantees your principal, safety and security of your principal. Your principal dollars go in the general account of the insurance company. Now, in an indexed annuity, your performance and your money is going to be tied to some sort of an index.
How much
Either
do you
the
usually
Standard & Poor's 500,
spend when you go?
500, a
Well, I have like
positive
20 something bucks over there. Normally it's like 50.
I have 42.
Generally, it could be tied to any other type of index
Thanks,
too,
baby.
that it's going to be tied to. But it gives you upside
you.
potential with downside protection. It's a type of fixed annuity. Right, the guaranteed minimum rate, usually written out in the contract, is 2 or 3%, maybe as little as 1%, and you receive a fixed minimum guaranteed interest rate regardless of what index performance does. If your index performance is better than the minimum guaranteed rate, then you get the performance based on the index. So it gives you upside potential with downside protection. Indexing, an investment method, it's linked usually to an equity index of some sort, S&P 500 or NASDAQ 100. Participation rate, yes, there's going to be a participation rate listed in the index annuity, and this participation rate is a percentage of the index gain that is kept by the contract holder, with the remainder kept by the insurance company. So if your participation rate is 90-10, you'll receive 90%, 10% will be kept by the insurance company. But don't forget, they're assuming all the risk. They're giving you upside potential with downside risk being taken care of. So there is usually a percentage participation rate listed right in an indexed annuity. Certain percentage is kept by you, certain percentage is kept by the insurance company. All right, that ends our discussion on annuities. Can there be more than one recipient of an annuity payment? Yes. According to the number of lives that you want it paid out. You want it paid out over one person's life, over two persons' life, or even over three persons' life. Usually, it's paid out over one or two people's lives because you're either dealing with an individual or a married couple, generally. Is a variable annuity owner guaranteed against loss? There is no guarantee in variable products, folks. They're tied to stock market performance, the ups and downs of it. So there's no guarantee in a variable product. Variable annuities are subject to market risk, so no, there's no guarantee in a variable annuity. Are lump sum deposits required to be made to purchase an annuity? No, premium payments may be periodic contributions. I don't have to put a lump sum in an annuity. I told you. I can start it with a lump sum of money. If it just so happens that I sold an asset and I have this lump sum of money to do something with, then yes, I can start an annuity with a lump sum. But if that never happens, I can start an annuity with a small amount of money.
Right, dude.
Something
done?
very
I'll stop
simple.
the bank.
Fuck you.
You can pay it like every tomorrow.
$20 just to begin. And then you just keep adding to it, adding to it, adding to
Mwah.
it.
I'll pay whatever I can on something. I just can't use my credit card.
For you, compounding there, faster there than anywhere else, for an income stream that you're going to choose at retirement or well into retirement years later on. Biggest performance, biggest use of annuity is retirement planning purposes. We use it for a lot of other things. Lottery winnings, lawsuit settlements, contest winnings, but the biggest use of annuities is retirement planning purposes. All right, that ends section 5. Now we're going to talk about section 6. Tax treatment of life insurance products. Tax treatment of life insurance products. Life insurance is considered a personal expense. Therefore, the premiums you pay for a life insurance policy is not tax deductible for you off your 1040 form. You don't know how I wish it was. I say to my CPA every year, they take that tax law yet? These premiums, all these premiums I pay on my life insurance, can I take it as a tax deduction? He says, no, Lynn. Can't do that. Haven't changed the tax law yet. Oh, darn. But if you've had your life insurance for a number of years, like I have, you've paid a good amount of premium for your life insurance over the years. And you don't know how I wish I could take a tax deduction for that. But it's not legal. You can't do it. You're breaking the law if you do it. So don't try it. Life insurance is considered a personal expense. Premiums you pay for individually owned life insurance are not tax deductible off your 1040 form. It's illegal if you do it. Death benefit is received federal income tax free, however, on life insurance. So even though I don't get a tax deduction for the premium that I pay, when I die, my death benefit will go to my beneficiary's federal income tax free. Cash value on a whole life insurance policy grows tax deferred. So far, the federal government has been smart enough to leave cash value life insurance alone and not tax us on the buildup of it. And that really is because we have the largest lobbyists lobbying senators and congressmen in Washington, D.C., who are second only to the unions. Unions have more lobbyists than we do. Otherwise, the insurance industry, pretty heavy weighted in terms of lobbyists lobbying congressmen and senators. And so far, it's paid off. They've left cash value life insurance alone. They haven't taxed us on it on the building. Hopefully, that will continue. Now, cash value inside a whole life insurance policy grows tax deferred. You don't pay tax as it builds up inside that thing. But upon surrender of that policy, cash surrender value is not taxable unless the cash value exceeds the premium cost basis that you have paid into the contract. Remember, you're always taxed on growth, Growth. So your cost basis is the amount of premium you paid into the contract, and you paid those premiums into the contract with money from your checking account. Money in your checking account or my checking account, we've already paid tax on that. So that's all after-tax dollars that you use to pay premiums on life insurance. So when you surrender the policy, you're not going to pay tax on the premiums you paid into it. That's your cost basis. But when you surrender it, you will pay tax on anything that's considered growth. That's money you receive above the cost basis of the premiums you have paid into the contract. So upon surrender of a cash value life insurance policy, it's not taxable unless the cash value exceeds the premiums paid into the contract known as your cost basis. Then only the excess growth is taxable. Cost basis consists of premiums paid into the contract for base policy only and not premiums paid for riders. Riders is extra protection at an additional cost. So your cost basis consists of premiums paid for the base policy only, not for riders paid, not for any premiums paid for riders. Dividends. What is a dividend in the insurance world? We already said a dividend in the insurance world is a return a part of the premium you have paid to the insurance company. Now, when they declare a dividend, they are willing to pay the part of that premium back to you in the form of a dividend. Dividend in the insurance world is considered a return of an overpayment of premium and are not considered taxable. But if you allow the insurance company to keep that dividend and let it earn interest for you, and at a point in the future you say to the insurance company, send me the dividend and send me the interest the dividend is made, it's true I will not have to pay tax on the dividend, but I will have to pay tax on the interest. Because interest is growth, and growth is always taxable to you in the year in which you receive it. Interest earned on dividends is taxable, even though the dividend is not taxable. Dividend in the insurance world is a return of part of the premium you paid with after-tax dollars. Therefore, a dividend is not taxable to you. But interest on a dividend is growth, and growth is always taxable to you in the year in which you receive it. Loan interest. Interest on a loan taken out of your life insurance policy is not tax deductible. Loan interest taken out of a policy loan, taking a policy loan out of your cash value life insurance policy, and the interest you pay on it is not tax deductible. That is not a taxable event either. Now, settlement options. Other than a lump sum, when death benefits are left with an insurance company, the interest is going to be paid on proceeds. No insurance company holds on to proceeds that they know they have to pay out at some point in the future without allowing that money to earn interest. That money left on an account with an insurance company will always earn interest for you. So when death benefits are left on account with an insurance company, interest is going to be paid on those proceeds. The interest is going to be taxable to you in the year in which you receive that interest. Now, when you surrender a normal life insurance policy, that policy is FIFO. If you've taken ever an accounting course before in your life, you learned about different accounting principles. One accounting principle is FIFO. First in, first out. Another accounting principle is LIFO. Last in, first out. So on a normally operating cash value life insurance policy, okay, when you surrender it, let's say you had a whole life policy for 20 years, got a sizable cash value built up in there. Now you say, I don't have a need for this policy anymore, I'm going to send it back to the insurance company, have them surrender it, send me a check for policy surrender value, cash surrender value. So, again, when you surrender it, you will not have to pay tax on the premium dollars you paid into it, because that's your cost basis. You already paid tax on those before you paid the premium out of your checkbook. And it's taxed on a FIFO basis. First in, first out. First dollars in were your premium dollars. So those are now considered your first dollars out. You can take those dollars out without paying tax on them. But growth is considered growth, and that's considered taxable to you. So FIFO is first in, first out. Dollars paid in first were premium dollars. Dollars when I surrender it are considered first dollars coming out, so I don't pay tax on that amount. I have to pay tax though on the growth. Premiums paid in are already taxed. They are returned first in a FIFO method, while the excess is going to be taxable as income because that's considered growth. Loan, when you take out a loan, no, you have to be willing to pay interest on the loan, but you don't pay tax on a normal policy. When you take out a loan, you pay interest on the loan. You do not pay tax on the loan. On a normal cash value life insurance policy. Once it's made a MEC, that will be different. Once it's made a modified endowment contract, that will be different. But on a normal cash value life insurance policy, it's operating normally. You take money out in the form of a loan, you only pay interest on the loan. You do not pay tax on it. Loans against the policy's cash value are received tax-free. You just have to only pay interest on the loan. Death benefit, tax-free to the beneficiary. Death benefit is going to be received by the beneficiary, federal income tax-free. And estate taxation, death benefit is included in the deceased estate for estate taxation purposes. When you own your own life insurance policy, the face amount of the policy increases your overall estate value. So when you die, that's part of your estate in calculating your estate taxation. Here's a modified endowment contract. Remember I said, as long as it's operating as a normal cash value life insurance policy, when you take a loan out on it, you only pay interest on the loan. You don't pay tax on the money you're borrowing out. But if the contract has been made a MEC, a modified endowment contract, that means the policy owner has put too much money in the contract and allowed that cash value to rise too close, too soon, too quickly toward that death benefit. And all it has to do is fail one 7-pay test rule, and that thing is going to be labeled a modified endowment contract the rest of the life of that policy, the rest of the life of that contract. So you never want a policy you own to become a MEC. You never want a policy you sell to your client to become a MEC. You need to go to Great Payton to make sure they understand not to make the contract a MEC, because then they lose all that beautiful tax-deferred build up, and it becomes taxable whenever they take any of the money out of a MAC. So modified endowment contracts. Premiums paid are not in proportion to the death benefit provided. In other words, the person overfunded it, put too much money in. So you have a nice, steady premium that needs to go in to this cash value life insurance policy, and it needs to go in over time. And that part of that premium goes to pay for the death benefit, and the other part of the premium adds to your cash value. So it keeps your cash value on track to increase, so that every year as it increases, it will, at least in a whole life contract, eventually reach the death benefit by your 100th birthday, at which point the policy matures or endows. That's a normal endowment of a normal cash value life insurance policy. But when a person pays too much money in the contract too soon, then they run the risk of that policy failing a 7-pay test roll. And all it needs to do is fail one 7-pay test roll, and then the IRS will say to that actuary, make sure you label that policy a MAC. Because now it's not operating like a normal cash value life insurance policy anymore. This person has dumped too much money in it, and that cash value has risen too close too soon toward that death benefit, making it an investment. And investments are taxable. So a modified endowment contract. Premiums paid are not in proportion to the death benefit provided. A MEC is an IRS, Internal Revenue Service classification of an insurance contract. It has to pass a 7-pay test roll. If it doesn't pass one 7-pay test roll, then from that point forward, it's labeled a MEC. And once a MEC, it's always going to be a MEC. There is no reversing it. So even if a person put too much money in and then realized, oh, I didn't mean to do that, I want to take the money out, doesn't matter. It flunked a 7-pay test roll, it's made a MEC, it's going to remain a MEC the rest of the life of the contract. 7-pay test, it has to pass. If premiums paid during the first 7 years exceed the net level premium that it would have taken to pay that policy up in 7 years, then it is considered a MEC, and it will remain a MEC the rest of the life of the contract. Then what happens once it's made a MEC? Disadvantages of making a policy a MEC is that any distribution at all, any withdrawal, any dividend, any loan you take out on a MEC is going to be taxable to you. It becomes taxable to you. Withdrawals are taxed on a last-in, first-out basis. So anything that went in that's considered growth is coming out first. You're going to be taxed on anything you take out, even in the form of a dividend, or a withdrawal, or a loan. It's taxed on a last-in, first-out basis, then LIFO. If you take out money out of a MEC prior to 59.5, the good old IRS will hit you with their famous 10% tax penalty, which applies then for taking it out before your full retirement age of 59.5. Advantages of making it a MEC? There really aren't any, except that the death benefit remains received by your beneficiary federal income tax-free upon your death. Death benefit remains income tax-free, and cash value growth continues to grow tax-deferred inside the MEC until it is withdrawn. But then once you withdraw it, you're going to pay tax on anything. Even if you don't withdraw it, you have to borrow it out, guess what? On the borrowing privilege as well, pay interest on the loan. Never want a contract you own to become a MEC? Never want to become a MEC? Because it loses some of the advantages that are normal. Taxation of group life insurance. Employer-paid premiums are deductible to the employer as a business expense. The death benefit is received always federal income tax-free. The cost of the first $50,000 worth of group life in your life is tax exempt to you, the employee. But the cost of coverage employer paid for the death benefit that exceeds $50,000 on your life will be taxable as ordinary income to you, the employee. This is the premium that is paid for coverage exceeding the $50,000. So said a little different way, let's make you an employee of an employer. Let's say that employer recruits. Because of that, they're going to offer you $100,000 worth of life insurance on your life through the group life plan. Now, I am getting a message that my internet connection is unstable, and that's probably because we're having a storm here where I am. So if I lose you, for whatever reason, if I lose you, I will be quick to try and sign back on again just as soon as I possibly can, okay? I'm watching my internet connection here, and so far so good, but just to let you know that. I'll also give you my cell phone number, which I'll give you at the end of the day anyway. My cell phone number is 954, area code 328-6000. 954-328-6000. I got my cell phone right here, okay? So if we lose connection for whatever reason, you at least could text me, and I could text you back and let you know what's happening on my end of things, okay? 954-328-6000 is my cell phone number. Okay, I'll give you that again at the end of the day. But at least now you have it in case we lose connection, okay? 954-328-6000, okay, is my cell phone number. All right, so getting back to the subject matter at hand here. Let's say they recruit you as a department head, department manager, okay? And by bringing you on board, they're going to offer you $100,000 worth of life insurance protection through the group life plan. And it is a contributory plan. You're going to pay part of it, the employer is going to pay part of it. All right, so for the cost of the coverage in excess of $50,000, that amount of premium that employer is paying for that amount of coverage in excess of $50,000 on your life, because they're giving you $100,000, that amount of premium in excess of the $50,000 that they're paying for you becomes a taxable benefit to you, and it's going to show up in box 12A, B, or C on your W-2 form at the end of the year. And your tax preparer, your CPA, is going to have to extract those dollars out of box 12A, B, or C and report it as income for you. It's going to be a taxable benefit for you. You're going to have to pay tax on any amount of insurance that's been offered to you in excess of $50,000 for which the employer paid any portion of that premium. That's a tax. It's not taxable to you for the first $50,000. Okay, so for the first $50,000, you're not paying tax on anything. But any amount of insurance offered to you through your employer that's greater than $50,000 worth of coverage, then the amount of premium the employer's paying for that amount of insurance on your life greater than $50,000 becomes a taxable benefit to you. And that taxable benefit, you're going to pay tax on it at ordinary income tax rates. And it's going to show up in box 12A, B, or C on your W-2 form at the end of the year. Your tax preparer is going to have to extract those dollars out of box 12A, B, or C and add up to your income for the year, because it becomes a taxable benefit to you. Anything above $50,000 offered to you by your employer and any portion of that premium paid on that amount of insurance in excess of $50,000 becomes a taxable benefit to you, the employee. Now, 1035 exchanges. This is section 1035 of the Internal Revenue Code that pertains to you wanting to move cash value from one life insurance policy over and put it in a different cash value life insurance policy, or moving cash value from one life insurance policy that might have already matured and endowed and moving that cash value to an annuity to provide an income stream for this person's retirement, or moving money from one cash value one tax-deferred annuity to a different tax-deferred annuity. If done properly, then the policy owner will not, or the annuitant will not, the annuity owner will not incur taxation. If done improperly, they will have to pay tax on it. So Section 1035 of the Internal Revenue Code, Section 1035 exchange rules of the Internal Revenue Code allows for a tax-free exchange of money inside one insurance product for yet another insurance product of a lifetime. Eligible exchanges include taking money from one cash value life insurance contract and transferring it over into the cash value of another life insurance policy, endowment, or annuity contract. Taking money out of an endowment policy, one that has already matured, and moving that money from that endowment policy over into a different endowment policy or to a different annuity, and taking money out of one annuity contract and placing it over in a different annuity contract. What you cannot do, what is not permissible, is what is listed here in red. You cannot take money out of an annuity and exchange that into a life insurance policy. You cannot do that. Because life insurance has bells and whistles. It has net amount of risk. It has bells and whistles that an annuity does not have. So you cannot take money out of an annuity and put it in a cash value life insurance product. You can take money out of a cash value life insurance product and put it in a different cash value life insurance product. You can take money out of a cash value life insurance product and put it in an annuity. That's okay. That's a good 1035 exchange. You can take money out of an annuity and put it in another tax deferred annuity. That's all right. That's a good 1035 exchange. But what you cannot do is take money out of an annuity and put it into a cash value life insurance product. That is no good. The IRS does not allow that to take place. An annuity cannot be exchanged for a life insurance policy. So, 1035 exchanges. The individual for whom the exchange is being made must benefit from at least some of the characteristics of the new product, including improved credit rating of the new issuer, better returns on the new product, and improved benefits of the new product. And you better be able to establish these in writing. The reasons why 1035 exchange in any product. The benefits being lost must be considered. Cash proceeds should not be received on exchange, and exchange should be completed within 60 days period of time. So, a little bit easier way to say that than all of this. Life kind of life, that's all we did. 1035 exchange. So life to life, that's good. Annuity to annuity, that's also good. Also, if the word life comes first, life to annuity, that's also a good 1035 exchange. But when the word annuity comes first to life, that's no good. That is not a good 1035 exchange. So lifetime to lifetime, that's always good if done the proper way. Person will not incur any taxation because they're just transferring it from one life insurance product over here to a different life insurance product with either the same company or a different company. They're exchanging money out of a life insurance product into an annuity with the same company or a different company. They're exchanging money out of one annuity to a different annuity with the same company or a different company. So lifetime to lifetime, that's always good. Life to life, good. Annuity to annuity, good. If done the proper way. And life to annuity is also good because the word life comes first. If you're trying to do it out of an annuity and put it in a cash value life insurance policy, that's no good. Because the word life comes first, the word life does not come first, and therefore it's not a good 1035 exchange. That's the easiest way to memorize that. Now, person cannot be in receipt of the check. They cannot receive the check. If they receive the check, they got to pay tax on it. So it's got to be a trustee to trustee transfer. Move it from one insurance company's account for this individual, sent to the other insurance company, FBO for your client, and dropped in their new policy. Or taken out of one cash value life insurance product, sent over to the different insurance company and dropped in their annuity. Or taken out of one annuity and sent to the other insurance company and dropped in for FBO for benefit of your client into the annuity you established for them. They cannot receive the check. If they receive the check, they're going to pay tax on it. So this is all done under 1035 exchange rules. All right, now we're going to play fill in the blank. Fill in the blank with the appropriate answer. The premiums paid for life insurance policies are not tax deductible. No, they're not. They're not tax deductible at all. It's all after tax money. Cash value in excess of cost basis is taxable if a whole life policy is surrendered. Interest paid on death benefits that are not distributed as a lump sum is taxable. Interest paid on death benefits, even though the death benefit is received federal income tax free, interest on the death benefit is held on account by the insurance company. When the interest is paid, it is going to be taxable because it's
Hey, Hoss.
is always taxable.
Good. I'm glad we got you. First of all, give me yours with the filling out something.
Are included in the deceased estate.
What's your
estate
address?
taxation
1199
alone, taken out. A modified endowment
Godfrey Avenue.
is taxable.
Uh-huh.
Modified endowment contract.
Spring Hill, Florida, and the zip code is 34609.
Benefit on a group life insurance policy is
Yes.
tax-free. And a 1035 exchange allows a tax-free exchange of a life insurance product for yet another of a lifetime. As long as it's done properly, you follow the rules of the 1035 exchange of IRS, you do it properly. Person is never in receipt of the check, therefore it never can be construed that they have received the money. So it's got to be done from trustee to trustee transfer situation. All right, that's the end of section 6. Now we talk about retirement plans and Social Security. First of all, you need to know what the difference between qualified and non-qualified annuities. Got to know the difference between qualified and non-qualified annuities or qualified or non-qualified retirement planning products. Okay? First of all, the word qualified. Qualified means pre-tax dollars are going in the plan. Dollars that have never been taxed. Those are qualified. Also, dollars you might put in a plan and be able to take a tax deduction off your 1040 form means those are qualified monies, pre-tax dollars going into the traditional IRA account. Let's say, for instance. So if you establish a traditional IRA account, make a contribution to it, take a full tax deduction off your 1040 form, then that means that money that went in your traditional IRA account is known as qualified money. It's money you've never paid tax on. But you got a tax deduction for putting it in there. Or if you roll money, transfer money out of your 401k plan that you had at one employer, and you want to roll that now to your own traditional IRA account that you establish for yourself and control yourself, then that money comes from a qualified plan. All that's pre-tax dollars. So it's got to be rolled into a traditional IRA account, keeping it qualified and keeping it growing on a tax-deferred basis. Can't roll money out of a qualified plan into a Roth, because Roth only accepts after-tax dollars. Okay? So, unless you want to pay tax on that whole amount of money in 1 year, you're not going to roll it to a Roth IRA. You're going to roll it to a traditional IRA account. So basically, any money that comes out of a qualified plan, any money that you can make a contribution for in a traditional IRA account and take a tax deduction for, means that money is qualified money. So qualified plans are available to different corporations that set up a qualified plan for their employees to contribute to, like a 401k, for instance. And those plans are known as qualified plans. They're receiving pre-tax dollars off a person's gross wages. So those are qualified plans, and they are regulated by ERISA standards. ERISA, Employee Retirement Income Security Act, 1971. So qualified plans are regulated by the IRS. ERISA, federal legislation passed by Congress in 1974, is what regulates qualified plans. A non-qualified plan receives only after-tax dollars. Non-qualified annuity, which you establish with, between your client and yourself and your insurance company, an annuity qualified is going to receive after-tax dollars in that person's check. That's non-qualified. It then goes in and grows on a tax-deferred basis for the individual for planning purposes later on. So qualified means after-tax dollars are going in. Non-qualified means after-tax dollars are going in. And the key differential between those two words. Now, contributions to qualified plans either go in on a pre-tax basis or they're deductible for the employee and the employer both. For any kind of company match an employer provides you, that's all money that they can take a tax deduction off the corporation tax return. So that is qualified pre-tax dollars. Any money you get is set aside in that qualified plan off your gross wages. That goes to the plan administrator, gets it off your account. That's all gross money. That's dollars you've never paid tax on. So contributions to a qualified plan can either be deductible for both employer and employee. Pre-tax dollars going in off your gross wages, company match dollars, employer could get a tax deduction off the corporation tax return for dollars considered as company match dollars. Non-qualified, deductible at all. It's all after tax money going in non-qualified plans. Now once it's in there, in both cases, the money grows on a tax-deferred basis. The money grows on a tax-deferred basis for a qualified plan, and it grows on a tax-deferred basis also for a non-qualified annuity plan. Distributions from qualified plans, when you get the money out, you don't pay tax on anything you take out. So pre-tax dollars went in, it grew tax deferred, you didn't have to pay tax as it grew. Now that you're taking money out, you're going to pay tax on anything you take out. All funds are taxed as ordinary income when you take the money out. Non-qualified plan, you put after-tax dollars in. While it's in there, it grows tax deferred. At retirement, you start to take the money out and pay tax only on growth. Because you're already paying tax on the principal dollars you paid in because you wrote a check, and those monies came out of your checkbook. So only growth portion is taxed as ordinary income on a non-qualified plan. All right, so here's ERISA. As I told you, for employee retirement income security in 1974. You got to know about ERISA. You're going to be working with clients, talking to you about qualified plans and moving money for qualified plans and rolling it over into traditional IRA accounts. You're going to have to know what the law says. Employee Retirement Income Security Act of 1974 is what regulates qualified plans. It was created to prevent misuse and mismanagement of pension plan funds for corporations' employees. Rules apply to private sector defined benefit and also defined contribution plans. A defined contribution plan is one where we are defining the contribution that needs to be made into the plan. A defined benefit plan is a defined benefit plan that we are defining the benefit we want to come out of the plan for that employee at their retirement. So there are 3 types of defined contribution plans. And the easiest way to remember them is look at the word contribution. It has 2 O's in it. Well, each of the examples of a defined contribution plan have O's in it. Profit sharing plan, O in the word profit. Stock bonus plan, O in the word stock, O in the word bonus. Money purchase plan, O in the word money purchase. So the three different types of defined contribution plans that exist are profit sharing plans, stock bonus plans, and money purchase plans. At least one of them have at least one O in the title. Defined contribution plan, we're defining the contribution that needs to be made into the plan. The word contribution has two O's in it. Defined benefit plan, we're defining the benefit we want to come out of the plan for the person's retirement plan purposes. So the one example I give of a defined benefit plan is the word pension. Two E's in the word defined benefit plan, one E in the word pension plan. So the one example I always give students of a defined benefit plan is a pension plan. That's a plan designed by the employer where money is placed in it for a defined benefit we want to come out of the plan of a certain dollar amount for that employee when they retire. That's a pension plan. And that's known as a defined benefit plan. Defined contribution plans, we're defining the contributions we want to place in the plan. That's defined contribution plan. Two O's in the word contribution, an O in profit sharing, O in stock bonus, and an O in money purchase plan. Just easy visualization technique to get yourself to remind yourself of how a defined contribution plan works, examples of it, defined benefit plan, how it works, and one example of it, which is a pension plan. Rules apply to private sector defined benefit and defined contribution plan. Determines qualified status. The employer and employee contributions are tax deductible. Earnings are typically tax deferred, gross tax deferred. Once the money goes in, it's all tax deferred for you. You're not paying tax as it builds up every year. Plans cannot be discriminatory and must be offered to all employees who have earned or 21. Plans are offered participation in the plans offered. They don't have to take you up on it. They don't have to sign up. They don't have to participate if they don't want to. But at least when they turn age 21, the plan administrator needs to invite them, send them the proper documentation, inviting them to join the plan if they wish to. And they have to usually have satisfied at least 1 year's worth of service to that employer before they are invited to join the plan. So they got to be at least 21 years of age or older and satisfy at least 1 year worth of work for that employer before being invited to join. An approved vesting schedule must be approved. The vesting schedule is always determined by the employer. We as employees of an employer have no say-so in what the vesting schedule looks like. That's determined by the employer. So an approved vesting schedule must be followed, which specifies the percentage of the employer's contribution to which the employee is entitled when withdrawing. Employees are 100% vested in their own contribution. Let me explain what that terminology means. Whenever you agree to qualified plan, let's say your employer is offering you a 401k plan. You're at least 21 years of age and you've worked for this employer at least 1 year. So now the plan administrator is going to send you documentation, many times nowadays in the form of an email, inviting you to join. And then they will attach an attachment, which are documents you can click on, print out, fill out, or maybe you can fill out those documents online and hit a button and send it back to the plan administrator, telling them, yes, I want to participate. I'm going to get started. To put it into the plan. So then you'll determine what percentage of your gross wages you want set aside out of your payroll check. Do you want 2%? Do you want 4%? Do you want 1% or 2%? Do you want 5%? 10%? How much of your overall gross wages per paycheck is taken out of you and sent to the plan administrator so that you can tell the plan administrator now how to invest those monies in those different supplements being offered to you through the plan administrator, through the plans. So, let's say I want to set aside 3% of my wages because my employer has said we will provide you up to 3% company match. So right away I know company match dollars are free money to me. I haven't worked over hours for those dollars at all. Company match dollars are free money to me. So if you don't like free money, if you do like free money, like most of us do, then it's incentive for you to do what? Sign up and at least have up to that same percentage of match dollars set aside for those wages. Because the only way I can capitalize on the full company match is to set aside at least up to that same percentage out of my own gross wages. So if I decide to start at 1%, then my company only matches me 1%. If I agree to set aside 2%, then they only match me 2%. If I agree to set aside 3%, then maximum contribution that they're willing to match is 3%. All the years. Leave it there and let it accumulate and work. The only way I can get 100% company match is to set aside at least that same percentage of my own gross wages up to that company match account to match me out. Too. So, some companies will have 55%, 6%. Only way I get the full company match is 75, that's 3%. If I set aside less out of my gross wages, then I only match me up to that same amount. So if you like free money, then you better participate and try your best to set aside at least the same percentage out of your own gross wages as what the company has promised to match you. Then you take advantage of the full company match. Now, whenever I decide to leave that employer, the money I have set aside out of my own gross wages is my money. I set aside labor hours for that money. That's my money. Those are my wages. So any percentage of those wages I set aside, I can take that money with me whenever I go. I can leave it there until I go if they allow me to do that. I can roll it over into a traditional IRA account that I myself control. I can pull it out and use it if I had a need to use it, or I can roll it over into a different 401k plan with a new employer if that plan is set up to receive prior 401k money, because not all of them are set up to receive 401k money. But if it is, then I can even roll it from that plan administrator over to the different plan administrator and put it in a new 401k account. So I can take my money with me whenever I go. But I cannot take 100% of the company match dollars with me when I go unless they have worked long enough for their employer to satisfy the vesting schedule. Sometimes that vesting schedule is a full 5 years. Sometimes it's a full 7 years that I gotta work for that employer before I become fully vested. Now once I become fully vested, not only can I take the money I set aside out of my own wages, which will always go with me whenever I go, but then I would take 100% of the company match dollars with me when I go. If I leave before I'm fully vested, then I leave some of those company match dollars behind. And that plan administrator cuts a check, and that money goes back to the employer. I never see it. Once I work for that employer long enough to become fully vested, though, then not only my money goes with me when I go, but I become fully vested in the company match dollars as well. And now I can take 100% of the money with me whenever I decide to leave after that. So, employees are 100% vested in their own contributions. But you're not going to be 100% vested in the company match dollars until you work for that employer long enough to satisfy that employer's vesting schedule. Qualified plans are approved by the IRS and receive favorable tax treatment. Contributions may be tax deductible or will go in on a pre-tax basis, one or the other. And once they're in there, they will definitely grow on a tax-deferred basis. Qualifications for qualified plans is that the plan must be in writing and expressed to employees that are about to participate in it. Once you reach 21 and you've satisfied 1 year's worth of service for that employer, that plan administrator has to send you documents inviting you to join. You don't have to join if you don't want to, but it's going to be one of the best ways you can ever save for your retirement. So get started as soon as you possibly can. And it also can increase your net take-home paycheck. So if I can contribute 3%, 4%, 5%, 6% of my gross wages and actually take home a greater net take-home paycheck than what I would if I wasn't contributing and get company match dollars to boot, why wouldn't a person contribute? Why wouldn't a person participate? And I can prove to you that that's the truth. Because you're paying less federal withholding, you're paying federal withholding on your adjusted gross, the gross minus your contributions. You're paying federal withholding on the adjusted gross. You still got to pay twice on the gross, but you pay federal withholding on the adjusted gross. So that means a larger net take-home paycheck is going to be paid out to you. Qualifications is that the plan must be in writing and expressed to all employees who are eligible to join. And once you have joined the plan, then there's communication that comes forth regarding the plan. You must satisfy age and service standards. Got to be at least 21 years of age. Got to work at least 1 year for that employer before you're eligible to join. The plan cannot be found discriminatory. What does that mean? That means they cannot allow the upper echelon of the corporation to divert larger percentages of their larger wages than we allow the same percentage of the rank and file employee to do. So, they cannot be found to be discriminatory. when plans are found to be discriminatory, that the upper echelon, the CEO, the CFO, and all these department heads are diverting larger percentages of their gross wages than we're allowing a rank and file employee to do, that's a discriminatory plan. That's a top-heavy plan. They're going to find millions of dollars. The IRS doesn't fool around. If they find that plan to be discriminatory, they're fining them exorbitant fines, and they're usually in the millions of dollars. The plan cannot be found to be discriminatory. That's what ERISA was all about. Contributions cannot exceed yearly maximums, and Congress sets yearly maximums. Usually 25% of a person's gross annual salary. I think the legal maximum is now up to $23,500 per year. It's the maximum contribution to a qualified plan. They adjust it periodically, just about every year, but they have to vote on it to increase it. So right now, they increase it from $22,500 up to, I believe, $23,500. Contributions cannot exceed yearly maximum set by Congress. They must provide survivorship benefits, must meet minimum vesting standards, and cannot be found to be top-heavy, where we allow the upper echelon of the company to divert larger percentages of their wages than we allow the rank-and-file employee to do. That's a top-heavy plan, and you're looking at fines being levied against the corporation by the IRS. Now, employer-sponsored plans, distributions. Here we'll talk about distributions. When you want to take money out of a qualified plan, you got some things to consider. Because it's in there and it's grown tax deferred for you, and it's compounding faster there than anywhere else you could put your money. So don't disturb it until you absolutely have to. Hopefully at retirement and well into your retirement years. Make this the last place you ever touch for money. This is not money you go on vacation with. This is not money you buy a new car with. This is not money you use for those kinds of purposes. You work and you save for that kind of money. But pre-tax dollars going in and working for you on a tax-deferred basis should be the last money you ever disturb. Because it's working and compounding faster there for you. And leave it alone and let it grow until you need it at retirement. Distributions, when you take money out, that's just a tax upon withdrawal. And you're going to be taxed at whatever tax bracket you fall in based on your income level for the year. But if you're still working and still in a high tax bracket, you're going to take the money out and you're going to pay tax on it at a high tax bracket. Plus, you're going to get hit with a 10% penalty on withdrawal and take it out of the 6 months past your 59th birthday. If you pull money out before age 59 and a half, you get hit with a 10% penalty levied against you by the IRS. That's going to be reported on your 1040 form when you file. Death or disability, if you pull the money out through the death or disability, you get a 10% penalty. If you divorce, court orders that money has to come out of the 401k or out of the qualified plan, then you get with the 10% penalty as well. Qualified financial hardship. The definition of qualified financial hardship by the IRS. And what they deem a qualified financial hardship and what you deem a qualified financial hardship could be two different things. You can pull money out of a qualified plan one time for the down payment on your first home purchase, and that amount is limited up to $10,000. You can't pull it out without penalty for a second home, or a third home, or a fourth home, or a vacation home, only for first home purchase. So your first home that you're, trying to scrape up enough for a down payment, or try and put as much down as you possibly can to keep your mortgage payment as low as possible, well, you can take money out of a qualified plan up to $10,000, and you can only do it once for a primary first home purchase. Not second, not third, not fourth, just first home purchase. Also, if you take out plan loans, you're not hit with the 10% penalty, okay? But you are going to pay interest on the loan. And usually plans will not allow you to borrow or take out a loan unless you continue to be an employee of that employer, but you pay the loan back to do a salary reduction. But at least you won't be hit with a 10% penalty. That would be mentioned by the IRS in any of these cases. 20% withholding. You decide to take money out of your qualified plan. The plan administrator is obligated by the IRS to withhold 20%, and they will send that 20% to the IRS. So they will send you a check for 80% of whatever you're requesting, because they're going to withhold 20% and forward it on to the IRS for taxation purposes. Exemptions from the penalty of taxation. If you roll it over, now rollover means you're sending for the money, the plan administrator cuts the check and mails the check to you, so you're in receipt of the money. Now you got 60 days to roll it over into a traditional IRA account or another qualified plan. Otherwise, you're going to pay tax on this whole amount of money in this given year. Now, these checks are large. They're in the hundreds and hundreds and hundreds of thousands of dollars generally. So if you don't get that thing rolled over into a traditional IRA account, not a Roth, because a Roth only accepts after-tax dollars, and this is all pre-tax money. You got 60 days to get that check deposited in a traditional IRA account, and you're going to pay tax on that whole amount of that check in that given year. And if you're still working, you got sizable income you're already paying tax on, so that just throws you into an unbelievable tax bracket. Never want that to happen to anybody. So rollover means the owner sends for the money and receives the check. Some people are just silly enough to say, I gotta see it, I gotta touch it, I gotta feel it, I gotta know that it's mine because I worked my whole life for this check. Yeah, but you don't have to receive it to know that, okay? You could just first of all, figure out where you want to put it after meeting with a financial person. Establish the traditional IRA account, either at the bank, the wirehouse broker-dealer, or with the insurance company, agent, and then send for the money. And have it trustee transfer over to the bank or financial institution, FDO for benefit of you, and then drop in. You're not going to receive the money. You never construed as a taxable event for you. That's known as a trustee to trustee transfer. A rollover means I send the money and I receive the check. And I only have 60 days to roll it over and get it deposited into that traditional IRA account wherever I send it. And I can only do one rollover per year. See, if I do it the better way, the cleaner way, the neater way, instruct the plan administrator only make the check out and send it to you, is that a plan or institution or financial institution or dealer for benefit of me, drop it in my account. That's known as a trustee transfer. The owner does not incur any taxation situation because I'm going to receive the money. The funds, receipt of the money, and I may do this any number of times throughout the year I want to. I can do as many trustee to trustee transfers as I wish, but I can only do one rollover per year. So there again, I don't want to receive the money. A neater, cleaner way is to establish a traditional IRA account for your client first, then tell them, okay, now it's time. Contact your plan administrator. They'll probably send you a link. They'll send you the form. Fill it out. Complete it, or fill it out online. Hit the button. Send it back. They'll cut the check because you'll tell them who to cut the check to the trustee, FBO for your benefit. And when they release it, it'll move right over here to this financial institution and eventually be dropped right in your account. Much neater, cleaner way. And you don't have to worry about being able to receive the check, and you don't have to worry about paying tax on it. Simplified employee pension plans, better known as SEP IRAs. Simplified employee pension plans, known as SEPs. These are ideal for small business owners. Business owners with a small number of employees. They are employer-sponsored IRAs, super IRAs, because they can contribute larger amounts than what a traditional IRA account can receive. Traditional IRA account can only receive $6,500 per year, $7,500 per year if the person is age 50 plus. That's a traditional IRA account set up by one person. But these super IRAs that are part of a SEP, you can contribute up to 25% of this person's gross annual salary up to the legal limit of $23,500 per year. So small employers and their employees, these are ideal for small employers and their employees. Contributions are tax deductible to the employer. That's why they are incented to establish a super IRA, SEP IRA for each of their employees and contribute an amount they agree to contribute because they can take that amount off the corporation tax return, get a tax deduction for it. Maximum contribution limits are 25% of the person's adjusted gross self-employed income, and it tops out at an index maximum dollar amount currently of $23,500 per year. TO plans are ideal for self-employed people. The legislation that was passed was called HR 10, and that evidently there was a senator by the name of Keogh out of one of the states that was instrumental in writing the legislation for HR 10, so they gave it his name, Keogh plan. TO plans are for self-employed people and their employees. They're self-employed or they have no employees or they have just a very few employees. So TO plans are ideal for self-employed people and their employees. Contributions are deductible to the employer. Traditional IRAs. Traditional IRAs are available to all individuals who have earned income. Got to be working and earning income to establish a traditional IRA account. It must be funded by cash or check. It cannot be funded by a stock certificate. But the value of that stock certificate varies when the stock market is open. So you cannot make a contribution with a stock certificate. That stock certificate has to be sold for a certain price and closed and settled. And then that money is deposited into your checking account, and you can write out a check for your contribution to your traditional IRA account. Traditional IRA accounts have to be funded by cash or checks. It can never be funded by stock certificates. It's possible for you to take a tax deduction off your 1044 for the amount of contribution that you make to your traditional IRA account. But a couple of things have to happen for you to be able to take the full tax deduction. You have to not be participating in any other qualified plan at all offered to you by any of your employers. Because if you are, you're already getting a tax break by contributing to that, and you cannot make a contribution and take a full tax deduction then off your 1040 form. Or if you are contributing to another plan, then you can still make a contribution to your traditional IRA account, but you might only be able to take a partial tax deduction off your 1040 form, and that's going to be based on the level of income you've earned for the year. So those are the things that limit the amount of tax deductibility for your contribution to your traditional IRA account. If you're not contributing to any other qualified plan, then feel free. Make your IRA contribution up to the legal maximum per year, which is now $6,500 per year, $7,500 if you're age 50 plus, and feel free to take the full tax deduction off your 1040 form for doing so. It's only if you're contributing to any other qualified plan offered to you by any of your employers that you can still make the contribution. You just might not be able to take the full tax deduction off your 1040 form. But your tax preparer will help you do that and determine how much you can still take as a tax deduction. So, possible tax deduction. Once the money goes in a traditional IRA account, it grows on a tax-deferred basis. If you're age 50 plus, then you have an additional catch-up contribution of an additional $1,000. So where the normal contribution limit is $6,500, if you're age 50 plus, you can contribute up to an additional $1,000 on top of the $6,500 for a total of $7,500. Maximum contribution limits is 100% of your earned income, and it tops out at an index maximum dollar amount of right now $6,500, $7,500 if you're age 50 plus. And when Congress decides to vote on that and raise it again, they will vote on it and raise it again. You gotta just be aware of tax law changes like that. So you give your clients good advice. You don't want them over contributing, because if they over contribute, the IRS will hit them with a 6% excise penalty and force them to take the money out. Because excise contributions cannot remain in a tax-deferred environment, growing on a tax-deferred basis. So they get hit with a 6% excise penalty, and they are forced to take the money out as well. Spousal IRAs, same amount, $6,500 per year, $7,500 if you're age 50 plus per year. These are offered by financial institutions such as banks, insurance companies, investment firms such as wirehouse broker-dealers, and have a wide variety of different investment options that you can invest inside that traditional IRA account. Think of a traditional IRA account as a shell, and depending on where you establish this shell, whether it's a bank, whether it's an insurance company, or whether it's a wirehouse broker-dealer, affects the type of investment vehicles that you can place inside that shell. You want to put gold and silver in your traditional IRA account? Well, then you better have your traditional IRA account established at a wirehouse broker-dealer, okay? Offered by financial institutions such as banks, insurance companies, and investment firms, and have a wide variety of investment options depending on where you establish that traditional IRA account. Distributions can be fully or partially taxed, depending on if you took a tax deduction for your contribution or not. Required minimum distribution is no later than December 31st of the year in which you turn now 73. Just this year, there was the Secure Act 2.0 passed. So now, by the time you turn 73, they delayed it another year, the year in which you turn 73, you must start taking required minimum distribution out by no later than December 31st of that year that you turn age 73. If you turned 72 last year, in 2022, then you had until December 31st of 2022 to take out your distribution. You could delay that first distribution to April 1st of this year, but you had to take it out by April 1st of 2023 for last year. And then you're going to have to take out another distribution for 2023 before December 31st of this year. That's if you turned 72 last year in 2022. If you don't turn 73 until this year, then you have until December 31st of this year, 2023, to take out your required minimum distribution. And your first required minimum distribution you can delay until April 1st of the following year, 2024. But if you do that, you got to take a distribution out by April 1st for this year, and you got to take another distribution out between April 1st and December 31st next year for next year. So most people don't want to do that because it's two distributions in 1 year, and it forces them into a much higher tax bracket where they pay higher tax on the distributions. They usually don't want to do that. They have to start taking it out by no later than December 31st of the year now. So the Year Act 2.0 that was just passed in January of 2023 delayed required minimum distribution age from 72 out now to age 73. Roth IRAs receive only after-tax dollars. You can't put pre-tax dollars in a Roth. You got to pay tax on the money first. You write out a check, establish your Roth IRA, and then make your contribution to your Roth. Roth IRA only accepts after-tax dollars. It's available to all individuals who have earned income, and it's always funded by cash or check contributions, never by stock certificates, never. Non-deductible contributions? No, you don't take a tax deduction for Roth contributions at all. You already paid tax on it. So you're not taking any tax deduction for a Roth contribution. Once it goes in then, it grows on a tax-free basis. As long as you leave it in there, at least 5 years, you keep the account maintained for 5 years, and you wait until you're up and over age 59 and a half before you start to take the money out. Then you can take money out of your Roth IRAs tax-free as well. So non-deductible contributions, once it goes in, it grows on a tax-free basis. Age 50 plus individuals can make up to an additional contribution of an additional $1,000. So the maximum you can contribute to a Roth per year also is $6,500 per year, $7,500 if you're age 50 plus. Now, if you wanted to make a contribution to a traditional IRA account and a contribution to a Roth IRA account, your contribution limits to both those accounts cannot supersede the $6,500 or the $7,500 per year. Doesn't matter which account you put it in, you can put some in both. But the maximum contribution, when you collectively count those two contributions, cannot supersede the maximum amount set by Congress, which is $6,500 per year, $7,500 per year if you're age 50 plus. I don't care if you put it in 10 accounts. You got to distribute it in such a way throughout those 10 accounts that it doesn't supersede the maximum contribution limit set by the IRS and set by Congress of $6,500 per year, $7,500 per year if you're age 50 plus. If you over-contribute, you're going to get hit with a 6% excise penalty, and you're going to be forced to take the money out. It cannot remain in there, growing on a tax-deferred or tax-free basis. Maximum contribution limits are 100% of earned income, tops out at an index maximum dollar amount, and I told you what those maximum dollar amounts are. Spousal IRA can establish their own IRA because it has to be owned by one person, so a non-working spouse can establish their own spousal IRA, but they have to be married filing a joint tax return with their spouse because they don't have any earned income. So to establish a spousal IRA, it has to be established for the non-working spouse, and they have to be married filing a joint tax return to be able to do that. Spousal IRA, maximum contribution amounts are the same. $6,500 per year, $7,500 per year if you're age 50 plus. These, again, are offered by financial institutions, banks, insurance companies, and investment firms, and have a wide variety of different investment options. So when a person asks you, do you handle Roth IRAs? Your answer is going to be yes, I do. When a person asks you, do you handle traditional IRA accounts? Your answer is going to be yes, I do. When a person says, hey, my CPA tells me I need a SEP, is that something you handle? The answer is going to be yes, I do. Okay? So study this because you're going to need to know it. There's going to be people out there that say, hey, you're an insurance agent. Do you handle traditional IRA accounts, Roth IRA accounts, SEPs, KIOs? Do you handle things like that? Qualified plans? Yes, I do. Yes, I do. I can help you with that. So, make sure you step right in there and help them out. Distributions. Distributions are qualified. They're not taxed from a Roth. After tax dollars go in, as long as that account is established for at least a minimum of 5 years, and you get up and over the age restriction of 59 and a half set by IRS, you pull the money out. You pull the money out tax-free as well. So, it's qualified and it's not taxed. It's not subject to you could live to be 120 on this planet and never take money they already got their taxation. So now you put it in there, and you leave it there, and it grows tax-free. As long as you leave it there an exorbitant amount of years, and you're up and over 59.5, now you take it out, then guess what? You take it out, tax-free as well. And there's no required minimum distribution. There's no backend restriction on Roth. There's a traditional IRA. Why is there backend restriction on a traditional IRA? Because you get tax deduction on you get a tax break. That's backend restriction. Because you reach a certain age, the IRS wants you to start taking money out so they can get their fair share of tax. That's why traditional IRA accounts have a required minimum distribution amount. But Roth, $1,000 go in, grows tax-free, comes out tax-free as well, and there's no required minimum distribution age requirements. Not on a Roth. It's all back-end benefits on a Roth. Where a traditional, it's all front-end benefits on a traditional. Now, Social Security. Social Security, Old Age Survivors and Disability Health Insurance, better known as OAS-DHI. Funding is through FICA payroll taxes. So with every payroll check you earn, 7.65% comes out of you, and it gets matched by your employer, 7.65%. So on your behalf, 15.3% is sent to Social Security Administration and dropped in and credited to your name and your Social Security number. Now, if you're self-employed, you pay the whole 15.3% yourself. You also are the employer when you're self-employed. You can pay double if you're self-employed. Of that 7.65% that gets taken out of you, 1.45% goes to pay for your medical benefits. Social Security offers you Social Security retirement benefits, Social Security disability benefits if you can qualify for them, survivor's benefits if you've worked long enough to be in the system to entitle you to survivor's benefits, and also a death benefit. That's a really little amount. Qualifications for Social Security. Work long enough in the workforce to reach what we call, or what Social Security calls, fully insured status. Now, I can only earn 4 credits in any one given calendar year. 1 credit per quarter of the year. There's 4 quarters in a calendar year. I can only earn 1 credit per quarter of the year. So the maximum number of credits I can earn in a given calendar year is the number 4. Never 5, never 6, never 7, never 10, 12, any number greater than 4. 1 credit per quarter of the year. Now, to reach fully insured status, I have to work long enough in the workforce to earn 40 credits. Well, if I can only earn 4 credits in a given year, then that means I've got to work long enough to earn 40 credits, which means I have to be in the workforce at least a minimum of 10 years to reach fully insured status, as far as Social Security is concerned. So fully insured status means the person has worked long enough to reach fully insured status by earning 40 credits, and that's 10 years worth of work in the workforce. That entitles them to maximum benefits. If the person only works long enough to reach currently insured status, that means 6 quarters of coverage during the past 13 quarters, which resulted in the loss. That's currently insured status. And that limits the amount of benefits you're entitled to. Primary insurance amount is your full retirement benefit at your full retirement age. PIA, you know what PIA stands for? It's your full retirement benefit at your full retirement age. Full retirement age, full retirement benefit at your full retirement age is known as primary insurance amount. It's an average index monthly earnings, and it determines what is contributed versus income payment being paid out. The more you work and earn, the more you pay into Social Security, the more the benefits you do when you retire. Let's cap out, though, it's just short of $3,000 per month, no matter how much you paid into. The maximum number of dollars that Social Security check are ever cut for is something just short of $3,000 per month. Okay? $2,900 and some odd dollars per month is the maximum benefit you could ever qualify to receive. So it does cap out at a certain amount. But the more you work, the more you pay into it, the greater you climb the corporate ladder or go in business for yourself, and the more the income you make and the more FICA taxes you pay, then that should affect your benefit up to a maximum cap. All right, we played match game here again. Self-employed retirement vehicle. A self-employed retirement vehicle, that would mean a SEP, IRA, or a KEO for either small business owners or self-employed individuals. Entitled to retirement benefits, that means a person has worked long enough for that employer to become fully vested according to the employer's vesting schedule. Regulates retirement benefits, that's ERISA. Employee Retirement Income Security Act of 1974 is what regulates retirement plans. It's to make them not be top heavy, to make them not be discriminatory against certain employees. That was the biggest reason for ERISA. Now, non-deductible. Non-deductible contributions, that's non-qualified plans and Roth IRAs because they receive only after-tax dollars out of your checkbook. And qualified for full Social Security benefits, that means you worked long enough in the workforce, 10 years minimum of years of work, you have worked long enough then to earn 40 credits, which is the minimum number of credits you have to work and earn to reach fully insured status, which means at least been in the workforce a minimum of 10 years. Because the maximum number of credits I can ever earn in a given year is number 4. So to reach fully insured status, I gotta reach 40 credits. And that means I gotta be in the workforce at least a minimum of 10 years. All right. Let's take a 10-minute break. It's 3:13. Be back in here at 3:25. That's a 12-minute break. I'm being generous. 3:25 by my clock here. 3:25, that's East Coast time. 2:25 Central time. 1:25 Mountain time. And 12:25 Pacific time. Okay, for all of those of you in different time zones across the country. Have a good break. I'll see you in 10 minutes.